What Bob seems to be saying here is that the market is expecting too high earnings, or higher than might be plausible here, and is willing to pay too much for them. Is that what fundamentally is being reflected in today's sell-off?
I think that's a large piece of it, that those fundamental issues will always play a role, but we've had several catalysts in the last, 2 trading days, whether it be Japan overnight or the market action on Friday after the jobs report, that give us some hooks to hang that coat on, if you will, and give people a reason to be concerned. So market action is always a combination of underlying fundamentals and catalysts, and we've had 2 kind of difficult catalysts over the last 48 hours, and that's why you're seeing volatility spike so much, especially this morning.
Nick, what are the levels you're watching now? And I thought it was interesting the point you guys have made that even if we see a slowdown and not a recession, we might have to revise earnings.
Yes. I mean, analysts are looking for 4 to 5% sequential earnings growth every quarter for the next 5 quarters. The typical growth rate's more like 2% in a non-recessionary environment. So numbers have to come down. They almost always do. Analysts are almost always too high. So markets kind of expect that. But if we start thinking about maybe flat earnings at $60 a share on the S&P, then Bob's point about earnings growth going forward comes into play, and we can't pay as high a multiple for that. Now, the offset's going to be if the Fed does begin a fairly aggressive rate cutting cycle, that markets have visibility into the back half of next year. And remember, markets discount 6 to 12 months ahead, and that begins to put a floor under stock. So it's a real balancing act right now, and that's why you're seeing the market swing around so much.
Nick mentioned the VIX. Bob, what is the VIX saying? And sometimes when the VIX does what it has done today, and that is go up as much as it has, it can signal that the market is bottoming.
Yeah, the VIX is indicating is in panic mode. Look, the long-term average on the VIX is about 20. When you start getting above 30, that's like concern. When you're above 50, that's genuine panic. So this morning we saw something very unusual, backwardation in the VIX curve. So the cash contract was 60 or above. The front month contract, the August contract, about 35, a little bit higher than that, and then everything else lower than that, even going into November when the election. That kind of extreme move there, 60 and then into the 30s for everything else, or even the low 40s, is very, very unusual. I'm talking about the magnitude of the difference. And traditionally, that has indicated some kind of short-term bottom in the market. And that actually appears to be what's going on. The low print today on the S&P 500 was right at the open. So the traders are very good at sort of panicking and telling the market when there's extreme selling pressure in the market. And the VIX backwardation is a very good indicator of that.
Nick, what has today's market action told you as we look now at the Dow down, closing in on a 1,000-point loss, which is kind of where we began the day? It went down a lot, came back a lot. What does this remind you of? Are there any historical allusions here?
Yeah, there absolutely are. Bob made the point about the VIX. I'll tell you, the VIX has never closed above 50 since 1990, except for 2008 and 2009 and 2020. That tells you how egregious that risk reading was this morning. It tells me that markets were genuinely panicked about what happened over the last 2 days. And it tells me also that we're going to have some volatility over the near term, because the history of the VIX is that volatility clusters. It never just spikes and then goes back down to normal. It hangs around kind of spicy levels for a while. And the other thing we know from recent history, say past 2022, is that the S&P doesn't bottom the day the VIX peaks. It takes usually 4 to 7 days for the S&P to actually bottom when the VIX spikes to a level not as high as today, but above normal levels. So the message is, history says, watch the market, keep looking for opportunities, but don't be rushing in to buy today.